Good evening. Good evening. Hello, everybody. I'm just quickly dropping this link into Discord. Bear with me. If you haven't been to Discord, amazing post by Steven. Steven, your efforts will not go in vain. We're making a switch. It's going to be a forced. We're all going to be there. We'll be jumping in there for meetings, and that will just have everybody ready to participate. So, yes. Join us now for options. Okay. Okay. Hi, Perry. Bob is here. Stephen. Hi, Sandy. Good to see everybody. I'm sure we'll have some more struggling in the meantime. We're going to dive on in. You should be able to see my screen. Let me know if that's the case or not. And let's get started. Officially welcome to the Market Watch Group Options Foundations 2.0. I really should have put that in my slides. 2.0. The next version may be 2.1 because we're not going to make a fundamental change like we did the first time, but we'll see. We'll see what we do. It'll be fun. Spread trading application session. That's today. Quick review. Dive into the platform. It's a beautiful time. Setups are happening. Got a little itchy today. Anybody? Market started okay, and then it sort of fell off. We'll do a little bit of market analysis to talk about what we think is setting up, but certainly expectations strong that we have some nice looking setups in context with our watch list. So let's dive in. My name is Scott. I will be your host, of course. Here are the disclaimers. Education, illustrative purposes only. Not intended as a recommendation to buy or sell. This is for education only. Yada, yada. Let's talk about today's agenda. What are we going to do? We are going to talk about intro to credit spreads again, just to remind you. So remember the building place or the jumping off point. We started with buying options. That's our foundation. Then we said, well, now that we understand better that, let's flip it and say, well, what if we were sellers? What would that mean? And we reversed it. Now we're saying, well, what if we start to do a combination of both? What's the natural next step? We just talked about selling. We're talking about adding a buy component to the sell. That makes a spread. That's why we're doing credit spreads next week, or not next week, Thursday, and then application day on Tuesday, debit spreads. I like them both. Even though I'm doing credit spreads first, I would actually say I probably do more debit than credit spreads. Not because it's like, oh, it's better because of this reason. It's better because the nature of what I'm trying to build and how I'm building it and what the volatility is. And I mean, it's, that's all. Some people have a misconception behind why they favor one over the other. We talked about this a little bit, but if you weren't here, remember that a lot of times people say, oh, it's credit spread. I love them. I put money in my account on the first day. It's not how it works, really. That's like saying, oh, I won on day one. No, you didn't win anything. You put the trade on. They put money in your account that is being held in the margin account. They took additional money. That was yours, that was already in your account, and they held that to the side. But it's less than if you did a cash secured put. It's less than if you did a naked put. Same basic premise. We're trying to capitalize on more than just the direction. These are still directional. It's still bullish. It's still a delta positive trade. We haven't talked much about the Greeks yet, but we are going to be getting into them more. But I allude to them a lot, right? Delta, direction, price going up or down, or expecting that it goes sideways, delta neutral. Theta, T, time, delta, D, direction or dollar. Theta, T, time. These little tricks I'm giving you, right? Don't miss out on the little tricks. So theta, time. Now what? Well, as buyers, we are always theta negative, period. Always theta negative. As sellers, we know that we're reversing signs. So when we reversed as sellers last session, selling puts, that brings in positive theta. It changes the direction of your Vega. Remember? So remember, it's delta, theta, Vega. That is price, time, volatility. What we're trying to do here is put time in our favor, but it's not so simple as to say we're putting volatility in our favor. If implied volatility is low and I put on a Vega positive strategy, that's putting volatility in my favor. But putting a Vega positive trade on would be something like buying a call or a calendar spread. That's Vega positive. That's going to add, right? That is trying to capitalize low volatility, because when volatility is low, what do we expect? It stays low or it escalates. And if it escalates, something that is Vega positive is going to capitalize on that. So we can't just assume that. Now, what's another reason why we might do a volatility trade? If implied volatility is high, that means that we are assessing relative to their historical patterns, the options are expensive. Do you want to buy expensive options or do you want to sell expensive options? Obviously, I want to sell. Now, if implied volatility is high, that's our assessment. What is our expectation? That if anything, it's more likely to come down. If it's more likely to come down, how do we put volatility on our side? When volatility is low, we put it on our side by being Vega positive. If implied volatility is high, we put it on our side by becoming Vega negative. Vega negative. So when options are expensive, i.e. high volatility, what are we looking to do to take advantage? Become sellers. Now, we can be sellers with covered calls. We can be sellers with naked puts, cash secured puts. We can be sellers with iron condors. That's coming in a couple of weeks. Right now, we're talking about being sellers with credit spreads, net sellers. Right now, we're going to focus today on bull put spreads. Why? Because our market posture score is bullish. Steven says, I know you can't see me shaking my head. I can't see it, but I can definitely feel it. I can feel the nods like, hell yes. Yes again. No, I love it. Yes, sellers. What else are we? So now what are we thinking? Bull. What does bull mean? You're bullish. You're delta positive. We want our net delta to be positive. What else do we want here? Theta positive. We want to put time on our side. What's the last component going to be? Sandy says she's confused. She's not. She's in a little bit, she thinks she is, but deep down, she's not. It's going to be amazing when it all just clicks. You have to, here's why today's going to be so important, Sandy, and so why I'm so glad you came. Because it's one thing to be like, oh, you sell the out the money, you buy the out of money. It all sounds, let's see it. Let's put it into practice. Then you'll have a recording that you can go try to replicate when you use the IB platform. Great, right? Yes. So what are we talking about? Well, we're bullish. Are we bullish with high volatility or bullish with low volatility? Unfortunately, it's low. Well, not unfortunately. Fortunately overall, unfortunately for bull put spreads. Am I thinking I'm going to put a lot of these on right now? Probably not. Are they still viable? They're viable because A, they have higher probability. When we buy calls, we need it to go from point A to point B. When we do bull put spreads, all we needed to do is get and stay above point A. And point A may actually be a little below us, where we're like, hey, if this thing goes sideways, I still make money. If it goes up a little bit, I make money. If it goes up a lot, I make money. Probability has increased. Okay, you just gained something. What should be the question that we asked? What's the pawn? If right, someone's not going to be like, hey guys, I'm going to give you higher probability of success. Doesn't that sound amazing? Come on, let's do it. And you're like, wait a second. What do I have to give you? What am I sacrificing? What is the pawn? Reward. Ah, Bob nailed it. Love it. He put it in just in time. R to R, baby. Reward to risk. Are we getting 3-to-1s, 4-to-1s? Now, maybe you have 3-to-1 or 4-to-1 from a, your risk and reward levels. If you're looking at max loss and max gain, there's no way, right? You're going to get like 1-to-1. It's going to look like 1-to-1 max loss and max gain. Am I willing to take max loss when I do these spreads? Of course not. If you're wrong, you're wrong. Whether you buy the call or you sell a bull put spread, if it, whatever, breaks support, if it has a big bearish engulfing candle on volume, if it takes, too long. Now, too long isn't so bad. You'll see here in a second when we're doing these types of trades. Too long loses its teeth. When we're buying options, we're like, oh yeah, I mean, after 7 days, I've tightened my stop or I'm done. I'm out of here. I'm not going to just sit and hold theta decay, theta negative decay as it gets worse and worse. Now, remember, when you have like a negative theta, it's going to be like -17, -18. It's pretty bad. Are you going to get positive 17 or positive 18? No, probably not. Because you're going to probably go a little further out of the money, which is going to be a smaller number. So yeah, not as much, right? We'll see. Let's get into it, shall we? Credit spreads. Intro, bull put is what we're talking about. What are the considerations? Jump to the platform. So, ooh, goodness, that is fast. Definition. What are we doing here? We're selling one option. That's the driver. That's why we're going to talk about that one first, right? That's the first step. We sell an option. When we think about building a credit spread, the first consideration is, where am I putting my short strike? Once we've locked in where we feel comfortable, then we can look at, okay, where's my long? Do I want to go a couple of strikes, 5 strikes, 4? There's no like, this is the exact right way. Some people always go $1 because that's what they've always done and that's what they were shown. Play with it. Play with it. Because I might go $1 on a $50. I might go $2 on a $100, $5 on 2. I mean, you just play with it and see what you can build. You'll start to see when you put the strikes together and you look at the reward to risk profile, where is time on your side? Where is it not? And that's the thing. You can't just assume that if you do a credit spread, time is always on your side. It's not. That's not how it works. And you'll see that. I will show you that. And you want to get comfortable building these in a pricing model so that you can paper trade them, so that you can get comfortable with them before you go live trade. What are we doing here? Sell one, buy one, same expiration on top of each other. Remember, these are also called vertical spreads. And we're trying to profit from what? The difference in premium. I take what I sell, I subtract what I bought, and I get a credit. That credit is max gain. Remember that. In options, as a seller, anytime you have a credit, the credit is the potential of the trade. If you sell a naked put, whatever credit you collect, that's the potential. If you sell an iron condor where you have 2 credit spreads, I have a bull put down here, I have a bear call up here. You put those together, the credit is the max gain. That's it. Now, the difference between the The strike prices minus the credit, that's your max loss. If you look at this and you're like max loss, max gain, like I said, at best, it's going to look like a 1-to-1. But that's not, just like if I buy an option, for the most part, I'm not willing to let it go to worthless. When we do a credit spread, there's going to be a point where we say, this is my line in the sand. And when it gets to that line in the sand, what is my risk? When we quantify that risk, then we're able to build a position size, right? So, what are the components? Selling first, that's going to initiate the spread. Remember that gives us an obligation. We are obligated. We have an option that is for risk management, for margin control. We would rather not have to use it. If you end up using the long option, that means everything went wrong. You stayed in it till expiration, and you are indeed at max loss. And if that is the scenario, the long option has protected you from losing more than a certain amount. But that, unless you position sized off of that, the loss is going to be worse than you expected. But these are the two components. Sell one, that's the driver. Buy one, that's the one that is there to, like we say, reduce the margin requirement. If all I did was sell the option, I'm naked. This long option covers me, but it's in this regard, it becomes a spread trade. Okay. Bull put spreads. That's what we're talking about today. What's our objective? That it remains, rises, or at least remains stable. And it does depend where we put the bull put spread. If I put the bull put spread far out of the money, there's a high probability it stays above. But what's my credit? Very, very small. If I put the credit spread right at the money, I'm going to get a much better credit. What's my probability that it's out of the money? 50-50, approximately. If I put it a little bit in the money, meaning a little above, it's going to give me a bigger credit. It's going to give me a different reward to risk profile. Here's the situation, though. I don't want to sell an in the money option. I don't want to sell intrinsic value. So if I'm thinking to myself, I want to be a little more aggressive, rather than sell in the money for a bigger credit, I'm actually going to switch gears and buy out of the money for a debit, right? Those two will function similarly. But if you ever sell intrinsic value, if you sell an in the money option, remember that equity options on stocks, are what we consider American style options. What does that mean? That means, I guess it's freedom. I don't know where it came from, but you can exercise at any time, as opposed to what, you might be asking, as opposed to European style options. And you might think, oh, European, so fancy. European style options are for index options. Why? Well, because it's not because they're better or worse. It's because you can't, right? With the options we're trading, there is an underlying stock. There is something to be physically delivered. If you're trading an index option, it's based on a number. There's nothing to be delivered. So they can't be exercised until expiration. At expiration, they are cash settled, which basically means whatever the difference is between the strike price and the actual closing price, that gets paid as cash. That's it. It just settles the contract because there's nothing to deliver. You can't deliver an index. An index is just a formula. And so index options, SPY, there's a stock. SPX, there's an index. So the index, the options tend to be about 10 times bigger. So for the most part, we tend to just stick with those. Okay. That's it. Let's move on to one last thing. What are the considerations what we would expect or prefer to see, high implied volatility. Higher volatility provides more premium, but it does also bring a little bit more risk. We want to make sure that we understand the margin requirements. The margin requirements are dictated by the spread itself, the width of the spread. Build it 2 points wide, $200 per contract minus whatever the credit is. So if you've ever traded something that's very, very expensive with options, let's say, for example, Chipotle, right? That's a $3,000 stock. It's getting ready for a 50-to-1 split that we think there could be some action there. But even buying an option that's a couple $100 out of the money is still going to be very expensive. What can you do? Well, you could certainly look at building a spread trade, because if you build a spread trade 5 points wide and your max gain is $2, your max loss is $3. So one contract has a max loss of $300. That's it. We can do that, right? Typically, that's something that even if you have a smaller account, you're probably going to be at or near that level where you could actually go build trades on things that maybe were never something that you looked into before. So that's probably one of the better advantages that this offers. You expect the stock to rise a little if you put it just a little higher than in the money. Stephen, that's a great point. I 100% agree. A little high, a teeny little bit of intrinsic value, okay. Right? Now, here's the deal. Just because something has intrinsic value doesn't mean we're like, oh no, it has intrinsic value, someone on the other side is going to exercise it. That's typically not the case. I have never one time called my broker and been like, exercise it. Maybe I did for a dividend one time. I can't remember. Probably not. But we don't buy options to buy stock. If you want to buy stock, sell options. I don't buy calls to buy stock. If I was going to use options to try to get a better price or to try to get into a stock, I'm going to sell puts, collect premium, eventually get put into it, and just constantly be selling premium. That makes sense. If you buy a call to buy the stock, all you're doing is paying more for the stock. That's worse. Just go buy the stock if you want it. Right? Does that make sense? And so that's most people's perspective. So we're not like, oh, the second it goes in the money, the closer it gets to expiration. Yes. If it's at expiration, guaranteed. If there's a dividend, higher probability. Right? So if you're looking at a stock and you see a dividend coming up, there's definitely increased probability that sellers or that people are going to exercise. So if you're a seller of that, you're going to be like, oh, I better be careful. I want you to be able to do risk assessment. Use an option pricing model to assess and control your risk, understand your reward. How does that work for a bull put spread? Lastly, how are you going to monitor and adjust these positions day to day? What are we going to do? Okay, right? Makes sense? Let's dive in. Let's go through the watch list a little bit first. We'll start here. What did the market do today? Well, had a bearish day. Above average volume? No, it was not above average. The market seems to be in somewhat of a flag or just a downward easing consolidation. Very easy. Looks great. Looks bullish. The buyers have taken a break. The sellers doing what? Are they clamoring in and pushing it down? No. Is it easing because there's some profit taking? Yeah, that's all we have so far. Great. I mean, I'm okay with it if it even comes a little more. But at this point, we need to be ready to go. This thing could be absolutely flagging, and we could have similar patterns. Now, bullish, check. What was the next thing we said we wanted for bull put spreads? High volatility. When you look down here at our implied volatility, that's not at all what we have. We have low volatility because that's part of what makes us bullish. The VIX is low. Overall, the general implied volatility profile of this market is low. Options are pretty cheap. So if you're one of the best ways to make money trading options is catch some good size move with cheap options. And that's exactly the type of thing that we're seeing right now. So let's now review the watch list and see what we can find that looks similar to this, but has a little higher volatility. Apple. Apple is one, right? That if you were to, it's holding, it's barely above. So I don't know. Some people don't mind if it's at this support level. It's a lower high. It could be a descending triangle, could be a double bottom. Let's keep looking. Let's keep looking. AIG, it's okay. We already actually looked at AMD for one. Apple is a donkey at the moment. Love it. Oh, how about AXP? It's looking bullish. We have a little bit of a flag. Volume's really dropping off on the sell. Implied volatility. Now, if it was down here at 20, I'd be a buyer, but where is it? It's not at the very high. That's up around 34. But remember that for me, implied volatility exists in two states: low, not low. Low, cheap. Not low, not cheap. Okay, right? That's that. This makes a little bit more sense. Let's take a peek at a couple more. BLDR. So BLDR also kind of in a little bit of a flag pattern, but you'll notice it's low empirically, like low relative to itself, but it is actually higher from a number. It's 40. So that's reasonably high. Citigroup, a little bit more pullback needed there. Caterpillar, not bad. See, what did I say? Chipotle breaking to the upside out of its flag on volume. Yep. Capital One, low vol, Costco, CrowdStrike. Watch list still looks pretty good overall. Look at DHI. That's got some pretty high vol right there. If you were going to try to trade out of this consolidation when it's done, that's got some vol. 35, AXP is 30. Should we look at a couple more maybe? Let's just see. See, this one's high overall, but it's only at 26. So I'm hesitant there. Home Depot. We got some nice trades setting up, I think. Meta. Oh, look at Meta pulling back. I mean, I still like it. I like it because communication services seems to be stronger and breaking out. As long as it stabilizes at or above 482, and you can see that the vol, there's a good amount here. So this is definitely one that we would look. Let's look into a couple of these. Let's start here. This is not a trade. I'm not suggesting this is a trade. Right now, it looks like it's in consolidation. This could keep coming. If you put a bull put spread on now and it keeps dropping, it will hurt you. Let's make sure we understand that. Please paper trade first, or assume any and all risks and liabilities. Okay, April, I would probably still go April, right? Do you start thinking, oh, I don't have enough time? Remember, time, as we think about time falling off of that increasing at a or decreasing at an increasing rate, falls off that cliff. We want that. That's helping us. So I don't mind going a little bit shorter to see if that time will accelerate. So we're looking at the Aprils. We're looking at puts. Where am I going to go? Initially, my thought is to go a little bit out of the money. So if I'm at 495 now, I might come down here, sell the 490, look at maybe the 480, and let's just start with something like that. What is the thought? What do we think it's going to stay above? Now, Stephen made the point. I don't know why I don't have extra room on my charts. Okay, so I mean, even here you can see if I go right at the money. Now, if it bounces higher, great. We don't think it's bouncing yet, but let's just start with this. Maybe we'll go at the money, and I'm going to go 495, probably by 470, which is a little below. And you might be thinking that's 15 points wide. Well, it's a $500 stock. Could I make it a little tighter? Probably, but do I want to? I don't know. Let's play with it. So I'm going to change my spread to vertical. I'm going to find the 495, which is right here. I'm going to come over to the bid price and I'm going to put a click in there one time. What do I have? I now have a 495 by 492.50 bull put spread. I don't want 492.50. I want a 470. So I come in here and I adapt that. And I now have 495 by 470. Actually, this is a little wide. Let me go 480. Yeah, let me go 480. Okay. So what do I have here? This is my bull put spread. Now, here's what I want you to understand about this bull put spread. Remember, I've got two lines here. I've got this straight line, which shows me at expiration. So when you look at this, it's a straight line. At expiration, let's dial this back to one contract to make the numbers make more sense. I have $900 of risk. At expiration, I have $590 of gain. So max loss to max gain is less than 1-to-1. So you might be like, whoa, I don't know about that, Scott. Okay, well, hold on. Right? Hold on. If I'm putting this trade on, it's because I think we're at support. So if I think we're breaking support, let's say down at 480, and I come back and I say I'm wrong at 480. Now, in this situation, the other line that we're working with is this purple line. This purple line is the day to day, right? Right now, if you look at the bottom left-hand corner, it's today's date in the pricing model. So I have today and I have expiration. And the way those two lines sit relative to each other tells me the story of this trade. How so, you might be wondering. Okay, so let's start with this point here, right in the middle. What does that point represent? That's my tipping point for time. When I'm on the right side of this, again, sorry. When I'm on the right side of this, time will go this way. This, as time advances, this moves higher, which means what? Over here, it's moving lower. And that might be something that I want to take into consideration when I build the trade. Okay. So that's time. What does that mean? Now we have a stop at 480. This is where we are. Now. And let's say that our target price is, we're going to say 540. Just putting it at 540 for now. 540. Okay. So what do I have? Well, if 590 is the max gain, at this point, I'm going to get at least 466. 466 out of 590 is what? Just under 80%. But remember, time is on my side. So the longer it takes to get there, if it takes 2 weeks to get there, so if I go out to the 10th, now all of a sudden, what do I have? Almost all of it, because time is on my side, right? So time is helping me here. Where is time not helping me? Where I'm wrong, right? Where I'm wrong. Now, what can I do to account for that? If I want this trade to be theta positive the entire time, what do I need to do? I need to sell so that this is in the middle, not right. So what am I going to do? I'm going to, let's put it at, so this is a call, but upside down. Well, it's not a call. I mean, I get what you're saying. It's bullish like a call. So just like a call, as we move to the right, which means the stock price is going up, we're making money. As it goes to the left, we're losing money. But it's going to have different considerations for sure. Let's move this down to 485 by 470. Nope, we don't even have to go that far. Let's go 490 by 475. Okay, so now it's a little bit closer. Maybe we should go down one more. 470. Yeah. Okay, now what? Now what? Now you'll notice this line where we said this is where I'm wrong. Let's go back to today. If you look at how much we're losing, right? If you look at how much we're losing, I want you to keep your eye on this profit or loss. It's $250. Now, as time advances, as long as we don't stop out, our loss is going to get less and less. And if we make it to expiration, we actually only lose $50 at that level. Only $50 to make what? 430. Oh, okay, that's pretty good. Right? Max loss 250 to make 430. Now, are we getting a good reward to risk ratio? Well, not nearly as good. Why not? Because this thing, as long as it doesn't stop out, essentially is going to make money. All it has to do, remember that right now, the stock is here at 496. It can drop $10. $10. And as long as it doesn't drop $10 before April 19th, this trade still makes $400. So what does that mean about probability? If the market goes up, you make money. Slightly up, you make money. If it stays sideways, you make money. If it goes down a little, you make money. As long as it doesn't drop below this level here. Now, we actually gave it to here. If it stays here or above, you get max gain at 485 or above. 485, that's right. That's right here at 485. If it stays above that level, you make maximum gain. This is not the same trade buying a call. When you buy a call, it has to go up. It has to go from point A to point B, and it's got to do it in 7 days, right? 7 days, 8 days. And the longer it takes, the worse it gets. This is very different. This is just like, hey, all it has to do is stay above. So we're not looking to swing for the fences with this strategy, right? That's a big core component. You're not swinging for the fences. You're looking for probability. Now, am I going to be willing to risk all of this? Of course not. If this thing breaks below this level here, life gets real bad over here. You'll notice that right now, let me get my drawing tool back out here. You'll notice right now, all of our lines exist in theta positive territory. Right? Positive, positive, positive. No matter what, as long as we stay above this. What if we get below this? Look what happens. Now, I want you to watch. Remember what I told you about this point right here. That's when theta goes from positive to negative. And the lower you get, the worse it gets. right in this area is the worst. So we try to avoid that. Right. So that's what we have the ability to do here. Now, what is the net result of this? I get a $4.35 credit, right? $4.35 credit off of what kind of risk? Remember that the risk really was about 250. So we're getting about 1.5 to 1 with what kind of probability? What is the probability it stays above what it is? I mean, 1.5 to 1. If we had 50-50 probability, that's 1.5 to 1 with 50% probability. That's a positive expectancy, right? If you make $1,500 5 times and then you lose $1,000 5 times, you're $2,500 up. That's what we're talking about here. Can we be right 50% of the time on this? Yeah, I think we could be right more like 65% of the time on this. We have better probability of success, right? Steven says even 80%. Yeah, okay. We don't have to be. If we are, all that does is boost your expectancy. If you have let's run the numbers, right? If I have 1.5 and I'm right 65% of the time and I'm wrong 35, that's a 62% expectancy. 1.5 to 1 reward to risk with a 50-50 accuracy, or I'm sorry, with a 65% accuracy rate, 65% accuracy rate. It's a 25% expectancy if you're 50-50. So what we're doing here is not like trying to be smashing home runs over the fence. Just get on base. Get on base, advance the runner. Get on base, advance the runner. It's a tactical game. It's consistency. It's Cal Ripken, if you remember Cal Ripken. Iron Man style, right? Always playing, always working, always getting on base. That's what we're looking for. So let's go back. Questions. There's got to be some questions. Steven said, so when you increase the date toward expiration, the line goes up. Does this mean we make a portion of the four? No, you don't make anything till you close the trade. That's showing you what your realized time decay gain would be, right? So what this is showing you, let's go back. What this is showing you is that if I put this trade on and in 2 weeks, it's gone up to 510. That's not that far, right? But I might be at a point where I can take 80% of my gains, right? And I might do that. Or if it makes the move fast, I might say, hey, you know what? I'm just going to sit on this thing now because I'm going to be able to get to 100%. You won't get this gain until you close the trade. So if you're just sitting around 490, you're probably going to have to, if you're trying to push it, you're going to have to push it to expiration. And that means here we're at the 13th. That means you're going to push it. And then as you get to the 19th, bam, we get it. That's where we get everything. Yeah. So that's why for me, if you're getting to 80 to 90% of max gain, that might be where you start to say, hey, you know what? I'm going to lock this in and go ahead and take it. I'm going to sell it. So this is a little bit more, this is going to be a little bit more conservative. If you want to be a little more aggressive with spreads, then what you're going to do is you're going to use bull call spreads. You're not going to be time positive at the beginning of those trades, but you will be time neutral. And that's better than time negative, right? So that's what we're going to get into on Thursday and on Tuesday's application session. Debit spreads. I mean, theoretically, I could build a debit and a credit to be theoretically the same thing. But in practical application, I find that selling at or slightly out of the money, if you're going to go in the money, barely in the money. But here you'll notice, for me to get the time decay to always be positive, where probability is really what's on my side, I have to sell. I have to sell a little out of the money, and I have to buy further out of the money. So I'm out of the money with this spread. What does that mean? It means probability is on my side, but premium's not. You're not getting huge premium. You're getting 435 on a $15 spread. That means your risk is about, theoretically, your risk is about 10.5. Make 4.5, risk 10.5. But we're not risking 10.5. We're only staying in this trade at or above this level here. And you can see right now from 496 to, what is this? 478. You're talking 18 points. 4%. A 4% move. And if you're at or near a support level, you think it's going to bounce. So the goal is to close the trade before expiration if the profit's good. Yeah. The second you close it, risk is gone. So if you've made 80 to 90%, you got to ask yourself, what are you doing holding on? Right? You've made 900. You can make another $100. What else could you do? You can give back that 900. You will feel foolish. I've done it. Maybe some of you have. And I'm like, what have I done? Why would I give that back like that? Okay. Let's pop out of here. Let's take a look at AXP before we run out of time. We looked at AXP for a covered call. Obviously, that was what? Bullish, high volatility. That's going to make it a candidate for a bull call spread, a bull put spread, a naked put, a covered call. All of those are theoretically going to be on the line. Okay, so let's add simulated trades. Let's pop in here, and what are we going to do first? What are we selling? Let's do the same thing, right at the money, selling the 225s if we thought it was bouncing. And we would probably have a stop loss maybe there. So let's go 225 by 215 just to see what that does. Yeah. 225 by 215. Again, 373 credit. Now it's a little better. I'm risking 625 for 375. So it's like 1.5 to 1 against. But what we say is I'm not letting this thing drop probably beyond this level here. Here's the problem, though. Have I had times where I thought this was going to happen and all of a sudden I end up in this area and I'm like, oh gosh, yeah, and that's painful. So you really got to be careful how aggressively we try to do something like this. Yep. So right here, for the most part, my thought is, if I bring this down to one contract, you're talking about $100 worth of risk, and that's around 220. So let's go see how comfortable we are at 220, we said. Now, again, this is still coming down. I would like this to be on the way up and then putting it down so that I have a stop and I could look to exit the trade. I could manually put that on so that if it broke the low, I can set the trade so that it would get me out. But yeah, it's giving me a little bit of room. Whoops. Back to the analyze, to the upside. Let's say it's only 8%, but that's still going to be somewhere around there. And my stop, we're going to put this about 220. Yeah, and you can see here the reward to risk is pretty good, actually. It's got a pretty decent reward to risk ratio. You might even give it a little extra cushion just because you can, but be very careful that this could get worse if you don't move it into a better position. What do I have? I have a delta positive trade. I think this stock is going up. I have a theta positive trade everywhere but my stop, and that's theta neutral. Why April 20? Because I don't need to give the buyers more time than they need. I could go further out. Let's test it. What if we said May? If we go to May, you'll notice it's not traded. What can I do then? 210s? What is going on? Do I only have... Yeah, I mean, I could go out further into May, but you'll notice you're only getting 70 cents a day. You're not getting very much time to kick. You are getting more credit up front. Yes. Is it more viable? Not necessarily, because if you look, I'm getting 70 cents, whereas if I go here and I go back to where I started, I'm getting $1.06. I'm getting double that. And that number there is going to rapidly increase as this trade, right? You can see how fast that starts to go. I'm not getting there until late in this trade. If I do a May, I'm never going to get there unless I stay in the trade for 60 days. So I want to balance the fact that I'm still directional for the most part, right? I'm still directionally trading. I'd still rather get 80% of this in a week, even if I put it on for 3 weeks, right? If you get 80% in a week to 10 days, do you want to wait the other 14 days to get the other 10 to 20%? I'd rather just be done. I'd rather be done and move on. That's the thought process. It seems like you could do a day trade to cash in on premium going out to May. I mean, you can day trade these, but they're not going to get a benefit of theta. Theta doesn't, I mean, theta is a daily rate. So if you're going to day trade, you may as well just buy a call in and out same day, because, you know, you're not losing much during the day. These are trades that you are expecting to be in, if you're right, at least 7 to 10 days. And during that 7 to 10 days, instead of having to fight time going against you at a pretty fast rate, you get to coast with time working for you. It's not as fast of a rate, but it's still working for you. So that's what shifts the probability. And if you were close, you know, are there times where you just sit on a trade and let it go to 100%? Yeah, sure. Let it go. So this is a very specific type of a vertical spread. We're selling time. We're buying a protective put to minimize the gap between the two, right? Remember that max loss exists between what we sell here and what we buy here. We don't want this to be too far. What's our margin requirement? On a trade like this, it's 10 points wide, right? That's $1,000 minus the fact that we collect a credit of 373. So they're going to make us put 627. If I confirm and send this trade, you'll notice that max profit 373, that's the credit. Max loss 627, that's my money I'm putting in. I can't lose the credit that I didn't put in. That's the credit. What I can lose is the money that I have to put in to cover it. Now, I'm not really willing to lose 627. I'm only willing to lose about 100, 150. Because if this thing breaks below 220, then I've lost my bullishness. This is not a strategy where I'm trying to buy the stock. If I was willing to buy the stock, I wouldn't have done the spread. I would have just done the naked put. Then I would have let the stock been put to me. Then I would sell a covered call. But this is a $500 stock, so 100 shares. That's a pretty hefty tag, right? It's definitely a pretty hefty tag. Questions, comments, or concerns? This week, if an alert comes out on a trade like one of these, there's a good chance that I would say either a higher probability at the money bull put, or possibly a more aggressive, slightly out of the money bull call. Did I cover the email on the AMD spread? Let me pull. Oh no, all my emails shut down. I'm gonna have to punt that one. We're actually out of time anyways. Sandy says I've got some studying to do. I will bring it up. All my I had to restart my computer today, and I lost all of my tabs. And I'm kind of a tab hoarder. I don't know if anyone else is like that, where I've got like 3 windows, 30 tabs on each one, and I'm like, I can't close it. I might need to access that. And I might need. Anyways, they all closed down. What that does mean is all my email stuff. So I have to, anyways, have to study these videos over and over to make sure I can understand. There's a good amount here for us for sure. Hopefully seeing this in application makes sense. We're gonna move on, and you'll see that next week we're gonna talk bull call spreads. Well, we're gonna talk debit spreads, but essentially bull call because we're still bullish. And again, every one of these that we do makes it a little bit easier. The application demo is helpful. Yeah, I'm glad to do it. Oh no, sorry to hear it, Stephen. Very sorry to hear it. Okay, well, very cool. Okay, it's good to see everybody. I hope I hope that you guys have a great. Now remember tomorrow. 50 minutes late. 10:05 a.m. I will put a reminder in this, but 10:05 there will be a reminder in the welcome screen. If you log in early, you'll just sit there and you'll be like, "Oh yeah, that's right. 10:05." Excellent. Good luck with him. He's a great coach, great trader. I will see you guys in the morning. Then we'll meet Thursday evening. Also Thursday afternoon. Let's plan on Thursday afternoon, end of market. Thursday afternoon, end of market, because there is no Friday. Thursday evening, we'll do debit spreads. Yep, 3:15. You got it. Thanks, guys. As always, happy trading.